Mike Tedeschi, Wealth Management Advisor, Perspective Wealth Planning, with this week's market breakdown video. What we're going to be taking a look at here in this video is the four major U.S. indexes. We'll check out bonds. We'll also take a look at the U.S. dollar. We'll take a look at commodities. But what I really want to focus in on is the difference between value and growth. And we'll see that when we start talking about, again, the Nasdaq versus the Dow. And we actually have some interesting data points that takes a look at the difference between value and growth and what historically has happened when we have this kind of spread. Let's jump right into it here first and foremost. S&P 500 just a stone's throw away from all-time highs. And, even though we had all that weakness over the last week or two, mostly in the Nasdaq, in the S&P 500, we still put in higher lows. So the uptrend is still intact, and we're looking for that break over that 3950 zone. The index looks really, really strong at this point in time. Here we are. We come back into the Russell 2000. And you can see we also held and made higher lows right in here, and we also are just a stone's throw away from new all-time highs. Now, when we come in here and we take a look in at the Nasdaq, we see a much different story, right? We are not near those highs. We had a 12-ish% pullback. We held major support from that breakout last year, but basically the Nasdaq now has gone nowhere since last August. All right, maybe a percent or so higher since last August, right? Here were our lows. We have made lower lows here over the last couple of weeks. We have also made lower highs at this point. So we are in a short-term downtrend channel against a long-term uptrend at a major zone of support. This was a very key level. We laid it out last week. I said we needed that 12,000 level to hold on the Nasdaq. It did. So the bull is still intact on the longer time frame. But over the last couple of weeks, we have clearly seen a rotation out of the Nasdaq and into where? Well, into the Dow. Look at the Dow. It's the only one of the indexes making a new all-time high, and it's done that now for a couple of days, right? We definitely put in higher lows, and we have now made higher highs. We are at all-time highs here on the Dow, and this has been kind of that leadership. We have seen money flow out of the Nasdaq and into the Dow. So we are seeing growth names, people taking profit, and putting them into value names. Now, when we take a look at the value to growth ratio, where value is up 5% and growth is down 5% over a 1-month period going back to the 1920s, we can see that value outperforms growth 100% of the time going into a 1-year time frame later. 100% of the time, the value has outperformed growth. And if we look from 3 months, 6 months to a year out, again, value tends to very much outperform growth, and the returns are very clear when we're emerging from multiple years of underperformance, like we are at this juncture right here. But the downside with this is in terms of actual returns, the total return on value was negative across most time frames, right? So value is outperforming growth, but both tend to not do that strongly over the next year. Let's look at that in data set. When looking at the returns on growth, they are very skewed towards the negative side. When we get out 1 year later, we're positive 63% of the time. But when you look at where we're at a month, 2 months, 3 months down the road, we're only positive a quarter of the time to maybe a third of the time. This is a big actual negative for those growth stocks historically. When we look at the S&P 500, when we have that same type of split, have very, very similar results, right? We're only positive 63% of the time. 1 month, 3 months, 6 months later, we're only positive a quarter of the time, right? This has typically not been a very good sign over the long run when money is flowing out of growth and going back into value. You can almost look at it as perhaps a flight towards safety, and that usually doesn't bode well from a risk-on type of environment. And lastly, here's the value on actual value stock. When we take a look, it's positive a higher percentage of the time, 75% of the time. 3 months later, it's positive 50% of the time. So it has outperformed, as you can both see, the growth and the S&P 500, but these still are not very good numbers. So historically, what this has meant, again, is that money has flowed out of growth into value, but money has kind of flowed out of the entire market over the course of the next 6 months to a year, but value holds up better than growth. That has historically been what has happened, which is why this type of split is a little bit concerning. When we actually take a look at what happened intraday a few days ago, the Dow was up 2% in the middle of the day, and the Nasdaq was down 3% at that time. That is the largest split between the Nasdaq and the Dow that we have seen since 1993. All right, so these are things that don't happen very often, and when they do, we should pay attention to them. Now, with that being said, we still have very strong charts across the board. The banks keep pushing and making new highs. The transports are acting extremely well. They keep pushing and making new highs, right? We typically do not have markets collapsing when banks and transports are leading the mode higher. The emerging markets have also done extremely well. Some individual economies better than others because there have been some that have had weakness. They're still up for the year, holding above a major multi-year breakout point. So again, if we look at this on a monthly chart, I mean, this is a pretty big breakout here. So we see growth globally. We see it in the banks. We see it in the transportation sector. So while there are some reasons to be concerned, right, we have to still pay attention to what the charts are saying. And at the moment, things look pretty good from a technical standpoint. Now let's go ahead and take a look at the U.S. dollar. When we take a look at the U.S. dollar, these lines, again, have been on the chart now for months. We have talked about the importance of this zone. When I back this chart up to a monthly basis, we got 20 years worth of price action in on this chart. This 88 to 91 zone is very long-term key kind of support. We fell down into it and we bounced back up. But if you look at where we're at right now, I'll zoom in here. The breakdown happened right around this 92 level, and that's where we so far have failed to push higher. So the way I'm looking at this is we've pulled into support, we made a first bounce attempt, we've run into resistance on a short-term time frame, and we've actually started to head back lower. At the end of the day, whoever wins this battle between 92 and 89 is going to ultimately determine our next move. So I think if we get back up, especially if we get back up over that 93 zone, it's looking stronger for the U.S. dollar. And if we fail right here, we would, again, need to take out 88 before we really can say that next leg lower is probably coming from a technical basis. Now, when we look at bonds, I'm taking a look here at the 30-year Treasury bonds. The really important level is that 154 zone, and that's actually where we started last year at. All right, so we had a breakout, and this is a back test here of this breakout during this time frame, and then we had that huge push during the panic last year, and we have slowly eroded this until this year where we have sharply headed lower. Now, you've heard a lot of talk about rates rising and what that can mean. This is the line in the sand that we do not want to lose, or rates will continue to head higher here, which will add some additional pressure to the market, which, of course, is an issue. So if you're watching that 30-year bond, watch that 154 zone, the lows that were put in a couple of days ago. A move underneath of that really gives us an opening back down to about this 146, and then we've got room back towards that 138. If this zone holds, the next important level is up here at that 167, and you can see that's an important level going all the way back to August, right? Last year when we had the big push, that was the first place that we made a bounce on, and that's where we made our first bounce here before ultimately rolling over. So those are the levels I would pay very, very close attention to here in the bond market. Now, let's jump in and let's take a look at commodities. Gold holding right there at that 1650 zone. Really kind of the last zone for me before I really wanted to kind of say, you know, this market is not looking nearly as good as you would expect it to, given the large multi-year breakout, the fact that it didn't hold as much of it as you would, of that move as you would have liked, and haven't gotten any follow through to the upside is, of course, concerning. But this, if you compare it and to actually look at that 30-year bond chart, they're very, very similar, right? If rates go up, people don't want to hold gold as much. They'd rather hold the bonds and get paid to hold those bonds at interest payment. When interest levels are extremely low, people are more willing to hold on to gold as that hedge. So I think what goes in the rate sector is also going to happen in gold. Now, the reason I still feel positive about this space is what's going on with the other precious metals. Silver has not pulled back, right? And usually you would see more weakness out of silver before you would gold if the next move was going to be lower in the space. The fact that silver is held up well and is a riskier metal, it's a lot higher volatility, and it's still holding up over that 26 zone. It hasn't come back and tested those lows back at 22 since really November of last year. This makes me think that there's still some very positive behavior out of the space. Platinum is still acting extremely well. We broke out over that 1,000 level. We pushed all the way up to 1350 before making a pullback. And again, if we look at where we pulled back to, this is a breakout with a back test. We held that 1150 zone, and now we're looking for that next push. Palladium still has not done much of anything here over the last 6 months. Still watching that 2500 level. A move over 2500 would be very positive, and a move back under 2200 would be negative for the space. We look at copper. Copper is still holding up over that $4 level. Back this out in a monthly chart. I mean, it's been a just a straight move up higher. You've heard me harp on it here now for 6-7 months. We've looked at this this copper chart, and we continue to head higher. And even when you see a little bit of weakness, like we saw over the last week or so, when the rest of the when the Nasdaq was selling, we started to see some money kind of flow out of here. What did it fall to? Right to that support and bounced right back up. So these charts continue to act well. We'll take a look in at oil now. Oil is continuing to push up. I'll back this chart up so that you guys can see a bigger picture here. We talk about the importance of the 65 level. I can extend this line out to the left, and you're going to see the reason why we talk about the 65 level. This is important for that inflection point all through 2018, right in here. That's that big battleground zone. It's the big battleground zone in 2019. It's where we failed in the beginning of 2020, and here we are right back again. The winner of this zone really determines that next move. The next move on the upside is to that 75. If we fail here, I would think we kind of fall back towards that 55 zone, which might be a good opportunity for another push higher if that zone were to hold. If not, you really have that 40 to 45 zone is that next area of support. But I think what happens here is going to be very, very important as well. So as you can gauge by a lot of the charts that we've gone through here, we're sitting at a lot of key levels and a lot of different things. What happens over the next couple of weeks is very, very important. As long as the indexes continue to push higher, we have leadership out of things like banks, the transports, the Dow is continuing to push higher. Those concerns of a full market rollover are certainly dissipated. But if we start seeing weakness both in the Nasdaq and in the Dow and in the Russell, we see weakness across the board. Again, there's a lot of reasons underneath of the surface to be a bit concerned. But until that actually happens, we got to go with what the charts are saying, and the charts are really across the board saying things are looking pretty good and things continue to push higher. As always, I hope you guys have yourself a fantastic week. If you found this video interesting, you want to have a conversation with me about anything that we've talked about here, anything dealing with technical analysis or investing, please give me a call at 814-580-9881, or you can shoot me an email at planning. I'll see you guys next week. As always, take care.